Hey everyone, in this video we're breaking down our trading strategy for this week. We're going to start by looking at this channel that has formed on the SPY. This has been going all the way back to September, October of last year. So this is nearly a year in the making. You can see we've had several tags here. And so our question going into the next week or two is, what are the probabilities that this trend line breaks, and how can we make money whether the trend breaks or whether we continue higher? So if we just zoom in here to the chart a little bit closer, we just had July options expiration last Friday. We're basically assigning a 50-50 shot from there. A lot of times what happens during big monthly OpEx weeks is a lot of positions are reset going into the next monthly expiration. And so there's kind of a 50-50 shot at that point of direction shift. And so we're just going to stick with that unknown and assign 50% probability that the market bounces higher from here and a 50% probability that the market continues lower into this trend line. But from that point, that's where it starts getting interesting. We're in this long-term uptrend here that we identified. And so we could say the probability for the trend to continue is going to most likely be higher than a break of the trend. It takes a lot of momentum to break a long-term trend like this. And so we're going to assign from this point here on the trend line, if the market does continue to sell off, we're going to assign a 65% probability that there is a bounce at some point along that trend line, and a 35% probability from this point down here that the market breaks the trend line and sells off. So if you recall, we're saying 50-50 shot from Monday that the market either bounces or continues selling off into the trend line. And from that point, it's 65 up, 35 down. So ultimately, if we think about it from today, the probability of this trend line breaking is 35% of 50%. So that gives us a 17.5% probability that this trend line breaks. I know that's a very simplistic way to look at it. We actually have a more sophisticated model, which is a multi-factor analysis, which incorporates economic data, earnings data, options data, number of different data points. But just for basic estimates, this method also works. And you could say, just on an estimate basis, could be anywhere from 10 to 25% probability that there is actually a breakdown of this major trend line. So given that basic analysis, we're going to break down how we find these trade ideas, how we determine where we want to go long and where we want to go short. How can we take advantage of the market and make the most money? So the first thing we like to do is a sector analysis. I'm here on TradingView's website in the sectors and industries section. We've sorted the performance by ascending. And so obviously electronic technology, retail, tech services, those have been the weakest performers over the last week. If we come down here to the other end, you can see some of the best performers are healthcare, financials, consumer durables. We mentioned there is a 17.5% estimated probability that the market breaks this trend line. And so who's going to get hurt the most in that scenario? Potentially some of the worst performers over the last week and month. So let's go into the electronic technology sector. These are the semiconductors, which have really been struggling as of late. NVIDIA down 10% on the month, down 8% in the last week. Names like AMD down 3% on the month, but down 16% in the last week. Qualcomm, all of these names have been affected by the larger market rotation that's been going on, more into small caps and other more defensive names out of some of the big growth stocks over the last week or two. And so I may look at putting on a short play in NVIDIA. This is actually a name we've been discussing in our community Discord. We can come over here and do a further analysis on NVIDIA by coming over to our gamma exposure dashboard and just taking a look at the overall structure. We can see NVIDIA does have large gamma exposure at the 127 and 130 strikes. So there is the possibility that if the market does bounce higher from here, NVIDIA could go with it and could start rallying up into these points. However, because it's been selling off and the market's been selling off, there is a stronger possibility that we could continue lower into this 115 to 112. This is actually our dealer cluster zone on the downside, where we do see some demand from dealers picking up at these levels just based on the option market structure. One way we might want to play this is by targeting, for example, this 115 strike by maybe buying a double diagonal. Maybe we would sell, for example, the 120, 122 call credit spreads. These would be shorter term bearish plays, assuming that Nvidia is going to continue lower over the next week or two. But we know there is a possibility for a bounce from these levels back up into these larger gamma exposure zones. And so that's something we want to be aware of. We like to structure our trades based on an asymmetric risk reward strategy. For example, we already have a long position on Palo Alto Networks. Palo Alto is in the tech services sector. So, if the market does rally here, Palo Alto actually has been outperforming the market over the last couple of days, basically trading in a larger consolidation pattern between 330 and 340 over the last few weeks. It's got large gamma exposure concentration at the 350 and 360 strikes. So if the market does rally, let's say the 50% chance we're assigning to the market rallying, Palo Alto is likely to rally with the market coming up into this 340 and 350 strike. So we would be profitable on that position in that scenario. The Nvidia position would most likely be a loser for us in that case, but the way we're set up is we will make more money on the Palo Alto trade than we lose on the Nvidia trade. And so that's kind of how we structure our overall portfolio, and each position plays off of each other position in our portfolio. So let's come back over here to our sector overview. Health services has been doing the best over the last week, up 5%. If we just drill down to see the market leader in the healthcare sector, that's obviously United Healthcare, largest market cap. Let's take a look at performance. United Healthcare up 15% over the past month, up 11% in the past week. So this is obviously a major mover. The best of breed in the healthcare services sector, which is currently the best performing sector in the market. So let's come over here back to our gamma exposure dashboard. Let's take a look at United Healthcare. And we can see, based on the gamma exposure structure, the market is concentrated at the 600 strike. United Healthcare is currently trading at 565. So the market is basically expecting a move higher over the coming weeks. We're already long this. We've been discussing it in our community Discord. We're long in our educational portfolio, expecting a tag of the 600 strike, maybe the 580 strike over the next couple of weeks, in which case we'll be profitable on that position. Let's come back out here to our sectors and industries analysis. Let's just sort again by performance over the last week. If we come down here to consumer durables has been just outstanding over the past month, up 15%. The largest impact to that sector is Tesla, by far the largest market cap in that sector. If we look at performance of Tesla, up 28% over the past month, up 1.4% over the last week. So if we just come back here to our gamma exposure dashboard, let's just dive a little deeper into Tesla, do a little bit further digging. Tesla's basically been in this consolidation range over the last several weeks between 240 and 260. The largest gamma exposure concentration is at this 300 strike. We've been watching this for a number of weeks now, basically waiting for Tesla to break out of this zone. Once it crosses this 260 threshold, all of the market attention is going to be on this 280 and 300 strike here. And so we're really just waiting for a breakout here, another 5-7% higher, and this is going to be a really nice breakout opportunity. That may take some time to play out, so right now we're just keeping an eye on it. But it's good to know when we just do our sector analysis that not only is Tesla outperforming the market, but it's in a sector that is also outperforming the market as well. And so depending on how much bullish exposure that we're trying to add to our portfolio, we could, for example, buy the 260, 280 call debit spreads. We could buy the 280, 300 call debit spreads. Those are going to be even cheaper, targeting the August 16th or maybe the September monthly expiration. Those are all different ways to play for a large move up in Tesla. This would represent about a 20% move higher. And so if you feel like that's going to take place over the coming, month or two, those are ways to play it, which are relatively inexpensive. That's kind of how we view implementing this asymmetric risk reward strategy approach. And so we teach all of this in our Geek University course. This is a 5-hour trading strategy course, free for all of our members. If you're interested, we'll put a link down in the description below. We'll also put a link to our community Discord. You can come on in, say hi. It's free. We've got a number of different channels where we discuss trade ideas, we discuss our portfolio. Definitely come check that out when you get a chance. Also, if you're interested in adding our Gamma Exposure dashboard to your trading arsenal, head over to geeksoffinance.com. You can become a member, get access to our dashboard, all the tools we offer, as well as full access to our community Discord and our Geek University trading strategy course. Anyways, that's it for this video. I hope you guys were able to find value in just a brief analysis to how we approach our trading strategy. Thanks so much, everybody, for watching, and we'll see you guys in the next video.